Welcome back, looters. I am your host on Tick to Loot, the channel where we turn ticks into treasure. Today we are on lesson 4.2 of Unit 4, Forex Basics. In this lesson, we're going to cover lots, pips, and spreads. By the end of this video, you will understand the basics of Forex trading and how to calculate your trading costs. Let's get into it. So what is a pip? A pip is the smallest standard price movement in the Forex market. For most currency pairs, like Euro to US dollar, 1 pip is equal to 0.0001. Think of it like a small step in the price movement of a currency pair. For example, if the Euro to US dollar moved from January 2000 to 1.2050, that is a 50 pip move. This means the price has moved 50 times the smallest standard price movement. However, for JPY pairs, like US dollar to Japanese yen, 1 pip is equal to 0.01. This is because the Japanese yen is a smaller unit of currency, so the pip value is larger. For example, if the US dollar to Japanese yen moves from 110.00 to 110.50, that is a 50 pip move. Just like with other currency pairs, this means the price has moved 50 times the smallest standard price movement. Now let's talk about lots. A standard lot is the standard unit of trading size in the Forex market. One standard lot is equal to 100,000 units of the base currency. There are also smaller lot sizes available, like the mini lot and micro lot. A mini lot is 1/10 of a standard lot, or 10,000 units of the base currency. A micro lot is 1/100th of a standard lot, or 1,000 units of the base currency. The pip value is the value of 1 pip in terms of the quote currency. For example, if you're trading one standard lot of Euro to US dollar, 1 pip is equal to $10. But if you're trading a 0.01 lot, 1 pip is equal to 10 cents. Now let's talk about spreads. The spread is the difference between the bid and ask price of a currency pair. For example, if the bid price is 1.2000 and the ask price is 1.2002, the spread is 2 pips. The spread is your cost of entering a trade. When you buy a currency pair, you pay the ask price, and when you sell, you receive the bid price. So, in this example, if you buy Euro to US dollar, you pay 1.2002, and if you sell, you receive 1.2000. Tighter spreads are better for traders because they reduce your trading costs. A tight spread means that the bid and ask prices are close together, so you pay less to enter a trade. That is everything for lesson 4.2, lots, pips, and spreads. If this helped you, smash that like button and subscribe to Tick to Loot so you never miss a lesson. Drop a comment below. What was the most useful thing you learned today? See you in the next lesson, looters. Keep turning those ticks into treasure.